You've been told that the people who win with money are the ones who care about it the most. The ones who check constantly, who track every number, who never let themselves look away. So you watch it. Every dip, every headline. You treat attention like protection. But what if the watching is the thing costing you? What if caring more is the leak, not the fix? Here's the uncomfortable part. The research keeps pointing the same way. The turning point isn't when you start caring more about money. It's when you start caring less in exactly the right way. Stick around. This one rewires how you think about control. Welcome to Max Sense, where we dig into the psychology behind what your brain actually does with money. Not budgeting tips. The deeper layer, why you behave the way you do, and how to use that instead of fighting it. Today is about the strange piece that shows up after the system takes over, not before. If that's the kind of thing you're here for, subscribe and stay. Let's get into it. The common belief is simple. More attention equals more control. More control equals more money. But two economists, Barber and Terence Odean, studied tens of thousands of real households trading real money. The most active traders, the ones watching constantly, acting constantly, earned around 11% a year. The least active, the ones who barely touched their accounts, earned closer to 18%. Same market, same years. The difference was how much they couldn't leave it alone. The activity was part of the cost. Trading fees, bad timing, and the urge to keep interfering all showed up in the returns. It's like adjusting the thermostat every 5 minutes. You never let the room settle. So if caring harder makes it worse, what does the alternative actually look like? And to be clear, this isn't about ignoring bills, missing payments, or pretending problems don't exist. It's about removing your anxious daily interference, but only after the system is built. Caring less in one very specific way. I'm going to walk you through 3 mechanisms. 3 reasons the calm version usually wins. The obsession tax, the system shift, and what I call detached competence. Let's start with what your vigilance is actually charging you. You know this person. Maybe you are this person. They check the balance before they're even fully awake. Then again at lunch. Again before bed. Nothing changed between checks. But the checking feels like doing something. It isn't a plan. It's a flinch. A nervous tick dressed up as responsibility, and it never once made them $1. This is what we'll call the obsession tax. And almost nobody sees the bill. Here's the logic. Every time you check, you create a moment where you might act. And action in the wrong moment is where the damage happens. The dip feels like a threat. So you respond to it. More checking means more chances to react. More reactions mean more mistakes. The vigilance manufactures the very moves that cost you. There's a known pattern in psychology where the more decisions you stack on yourself, the worse each one tends to get. Constant monitoring turns one calm yearly decision into 1,000 tiny anxious ones. Each one a chance to slip. But here's the part almost nobody catches. In controlled experiments, people who saw their results less often were willing to take smarter long-term risks. When you watch too closely, every small loss screams at you. And losses feel about twice as loud as gains. So the frequent watcher pulls out of perfectly good positions, scared off by noise that the patient person never even hears. The same researchers found the people who traded the most often did the most damage to their own returns. The confidence to keep touching it was the problem, not the lack of attention. That gap between 11 and 18% isn't abstract. Stretched over a working life, it's the difference between 2 completely different retirements. Picture planting a seed, then digging it up every morning to see if it grew. The digging is why it never grows. Money compounds in the dark. It needs to be left alone to do the only thing it's good at, quietly accumulating. Monitoring more isn't managing better. It's paying more to earn less. So the first move is almost insultingly simple. Cut the number of times you look. Not 0. Structured. A set review, monthly, maybe quarterly, instead of a reflex you reach for 40 times a day. Kill the market noise alerts. Keep the ones that protect you: fraud, due dates, low balance. The market needs no witness. That's the first leak sealed. Now, the second mechanism is where the real shift happens. Every month you tell yourself the same thing. This is the month I save more. This is the month I get disciplined. And then life happens. Something comes up. You'll do it next month. You've been doing this for years. This is the willpower trap. And the way out isn't more willpower. It's a system. Here's the logic. Willpower is a moment-by-moment fight. And you have to win it every single time. A system only needs you to win once. You set it up and then it makes the choice for you forever. The cleanest proof comes from how companies sign people up for retirement plans. When people had to actively sign up to opt in, about 37% of new hires did. When enrollment was automatic, opt out instead of opt in, participation jumped to 86%. Similar workers, similar paychecks, a different enrollment design, and the default changed the outcome. That gap isn't a statistic. It's the difference between someone starting early and someone staying on the sidelines for years. Other researchers tried a different fix. They simply forced people to make a clear choice, yes or no, on day one. Just removing the option to put it off later raised participation by nearly 30 points. Procrastination, not laziness, was the enemy. And here's the kicker. Financial education, actually teaching people, moved participation by a fraction of that. Education helped, but usually modestly. The design of the choice changed behavior far more. That should bother you a little. Because it means the problem was never your character. It was your setup. It gets better. Researchers built a program where people agreed to raise their savings, but later tied to future raises. Because the increase came out of money they didn't have yet, it never felt like a loss. The saving rose on autopilot. Their average savings rate climbed from around 3.5% to over 13% in under 4 years. They didn't have to rely on discipline every month. They made one commitment early, and the system carried it forward. So the second move is to automate the next recurring decision you keep failing. One transfer, one contribution, one time. Set the auto transfer the day you get paid. Set the bills to pay themselves. Then close the app and live your life. The goal is to remove yourself as the weak link, to make the right thing happen even on the days you don't care. The system doesn't replace your discipline. It makes discipline unnecessary, which brings us to the third and strangest mechanism. You've met someone like this. They seem weirdly relaxed about money, almost careless, and yet they're doing fine. You assume they don't care. You assume it's luck or a high salary or some secret you weren't told. But here's the question nobody asks. What if their calm isn't carelessness? It's the opposite. Here's the logic. The calm person isn't someone who never cared. They're someone who did all the caring earlier. They front-loaded the effort, the deductions, the auto-transfers, the rules, and then they were free to stop thinking about it. The competence didn't disappear. It moved upstream into the structure so daily life no longer demanded it. This is detached competence. The piece on the surface is built on machinery underneath. Psychologists who study habits found that a repeated behavior becomes automatic after roughly 2 months, on average. It's an average, not a promise. For some it was a few weeks, for others many months. But the direction holds. After enough repetition, the action stops requiring a decision at all. It becomes the path of least resistance. Think about that. 2 months of small repetition buys you years of effortless behavior. The calm person just paid that price early. And missing 1 day didn't break it. The system is more forgiving than your guilt ever told you it was. So the person who looks effortless, they're not exerting heroic willpower. They're coasting on rails they laid down once. Research on self-control points the same way. The people with the best outcomes weren't the ones gritting their teeth hardest. They were the ones who'd built better habits, so the hard choices rarely showed up to be fought in the first place. So the third move is to let yourself detach on purpose. Pick a review rhythm quarterly, yearly, and trust the machine between checks. The detachment isn't neglect. It's earned. You built something that runs without your anxiety feeding it. Peace isn't the reward for winning. It's what's left when you stop needing to win every single day. Now, I can already hear the pushback. So you're telling me to just ignore my money and hope it works out? And that's a fair objection. There's a real version of detachment that's just neglect. Ignoring problems isn't peace. But notice the difference. Neglect is the absence of a system. Detached competence is the presence of one you trust. A pilot on autopilot isn't ignoring the plane. They built and verified the system so they don't have to grip the controls every second. The setup phase demands real attention. You earn the right to detach by doing the work first. And detaching doesn't mean never looking. It means looking on a schedule you chose, not in a panic the market triggered. The quarterly check catches what matters. The 40 times a day check just catches noise and charges you for the privilege. Both things are true. Pay attention when you build it, then let it run. Alright, you know what's happening. Now let's talk about what you can actually do with it this week. 1. Cut the checking. Turn off the market alerts and set one review day. Monthly is plenty for most people. 2. Automate one decision you keep failing. Set a transfer the day you get paid, before you can talk yourself out of it. 3. Put your recurring bills on autopay so a forgotten due date never costs you a late fee again. But only after you keep a small buffer in the account. Automation without cash flow is just a faster way to get hit with fees. 4. Pick your detachment rhythm. Decide right now how often you'll actually look, and let the silence in between be the plan. None of these require more discipline. That's the entire point. They require less of you on purpose. Do these 4, and the next time the market dips at 2 a.m. you won't even know. Because you won't be watching. And that's the whole point. If you want to go deeper on the psychology behind this, there are a couple of books that lay it out beautifully. I'll leave them in the description. They're the kind of thing that makes the calm version feel obvious in hindsight. No pressure, but if this idea clicked for you, that's where to take it next. So here's where we land. The people who win with money long-term usually aren't the ones thinking about it the most. They're the ones who cared intensely once, set the thing up right, and then earned the freedom to stop. Care once, design well, check rarely, then let it grow in the dark the way money was always meant to. The goal was never to care more. It was to build something good enough that you finally could care less. That's the version of wealth nobody puts on a thumbnail. Quiet, automatic, almost boring. And that's exactly why it works. If this reframes something for you, subscribe and stick around. I'll see you in the next one.